What's this whole financial crisis of 2008? Why is that such a big deal?
Stop, Common Cody. The financial crisis was very important.
Who are you?
I'm Action Rob, and I'm here to talk to you about the financial crisis of 2008.
Action Robin, Common Cody. Action Robin, Common Cody. Action Robin, Common Cody. American teachers. Action Robin, Common Cody. Action Robin, Common Cody. Action Robin, Common Cody. American teachers. Oh my God, this is so boring.
Shut up, Common Cody. The financial crisis of 2008 was a big deal. There's a reason why it was called the Great Recession. Big companies like GM went bankrupt, along with important banks. It was a hard time for many Americans.
Wow, the U.S. is so awesome. Even the recessions were great.
That's the spirit.
Well, in this case, what started this recession?
Well, I'm glad you asked, Common Cody. That would be the housing bubble.
What's the housing bubble?
Well, CC, it's something that's been happening for a long time. The prices of housing and real estate have been rising for years. Between 1998 and 2006, the price of a typical American house increased 124%. The national median home price rose from 3.1 times the median housing income.
Well, so does that mean that the house prices rose 3 times faster than people's incomes?
Cody, that's what I just said. No wonder you can't afford your house.
I live in a box.
Exactly. Anyways, after peaking the housing prices in 2006, the price of real estate began to decline. Once the credit market froze in the summer of 2007, shit got real.
How real?
Real. In the August of 2007, there was a worldwide credit crunch where subprime loans just weren't available. In that same month, the U.S. subprime lender American Home Mortgage filed for bankruptcy and the housing market crash officially began. Housing prices began to decrease, and many people's mortgages were much more than their houses. Mortgage companies who had been giving out so-called ninja loans with no income, no job,
Time out. I gotta pee.
About time. I was talking about ninja loans before. These loans were given to people with no income, no job, and no assets, based on the idea that the housing prices would keep increasing. These loans began to lose a large amount of money. Without the increase in housing prices, the loanees were unable to pay back their loans. These companies, like the American Home Mortgages, were going bankrupt at an alarming rate.
Well, what does this whole housing crash thing have to do with the rest of the economy? So some people can't buy houses. So what?
Well, CC, all the loans I talked about earlier were given out to banks and mortgage companies, and they got hit hard when the mortgages from the housing market started to default. Soon, banks began to fail all around, mostly due to these things called derivatives.
Derivatives? Those like the things that Salto was trying to teach us about the other day?
Derivatives are a type of security for investments. To put it simply, pooling your money with others to purchase insurance on the risky loans you have given out. They are essentially a way to bet against yourself and still make money in the event that your investments should turn out to be bad. Originally, derivatives were futures, making a deal to buy something for a certain price for a certain time in the future, regardless of the conditions then. As time has gone on, derivatives have increased in complexity. They have become based less on commodities and more on financial systems. Trading of currencies, selling loans to other banks, and changing interest rates can all be used to give a bank security. These started out small and only for the purposes of security, but the use of derivatives eventually increased and were used by some to actually make a profit.
Well, that sounds pretty bad. Were there multiple types of derivatives, or were they all the same?
Well, Common Cody, let me explain. There are two main types of derivatives that are most often associated with the Great Recession. First off, we have collateralized debt obligations, or CDOs for short. CDOs were a way for several companies to create a large reserve of their assets so they could call upon it in the event that they run into trouble and need to use it. These gave companies a way to find security even if their own industry was experiencing trouble. This is because companies in different industries could create a CDO together to offer them all security and allow them to diversify.
Oh, so kind of like the jar of money I have next to my bed that I use to make bail when I need to.
Yeah. Kinda. Anyways, a credit default swap, a CDS, was also another type of common derivative, which is where a company could pay to another to help them out in an event that their loan was defaulting upon. This is a very simple to buying insurance on a car or home. However, when the housing bubble popped, it did not act this way because they had been traded so much. Without any regulation to ensure that the trades were with someone with large enough reserves to pay for it, many of them did not work. Prior to the recession, there was $45 trillion in CDSs, approximately double the size of the stock market.
So basically, the insurance companies went broke.
Yep, their systems were perfectly safe when we had a stable economy. However, with the recession began, it was only helped to make them worse. As the housing bubble popped, banks began to fail. The system of derivatives had gotten too complex, and the bankers were unaware of where their insurance was coming from. In addition, they did not keep large enough reserves on hand to pay them off in case they failed, which they did. This caused several banks to go under, most notably Lehman Brothers, bringing other with it.
Wow, sounds brutal.
It was. The blame can't all go into the banks. There are many other groups that aided in the perfect storm that was a financial crisis.
Ew, I remember that movie. I was pissed myself when I heard that whole tsunami thing.
Cody, we're not doing a movie review, but I paid myself too.
Yeah, I do it.
So, financial crisis, money.
Yeah, you're the smart one here. I'm just here for the shacks.
Okay, so AIG. It was an immense insurance company that issued out credit default swaps, which was essentially insurance against bonds and mortgages, to the high premiums that would pay towards insuring. In this way, the party paying for the CDS would get money for bonds or mortgages defaulting.
I heard that so many people were losing money that a van full of Americans were caught trying to smuggle themselves into Canada.
Canada? Like America's hat? Must have been pretty bad then. But despite enormous foreclosure rates, AIG kept selling these credit defaults and collecting premiums on them. AIG had to give out tons of money to people whose houses were foreclosed on. By 2008, AIG was losing billions of dollars per day due to their practices. AIG is an immense insurance company. One of its functions is to insure bonds against default. For example, if a pension fund bought bonds from GM and also wanted to insure the bonds from defaulting, the pension fund would be buying insurance from AIG.
Wait, it sounds like CDs.
CDSs, yeah. And the pension fund pays for a premium in this insurance. As the subprime mania continues with everyone buying the mortgage-backed CDOs, they also wanted to buy insurance from the form of CDSs, in some cases mortgage defaults. The transfer of the risk of bonds defaulting to the seller, credit default swaps in the form of a case of AIG.
There were also those who believed the subprime mortgage industry was a disaster waiting to happen. So they went out and just bought the credit default swaps. When default swaps started on the mortgages, they made money by owning the credit default swaps, something like shorting a stock. When you think it will go down and you short it, owning these credit default swaps was a way of shorting the subprime mortgage market. How did the U.S. government help these poor, troubled companies?
Well, good question, Common Cody. One of the ways was TARP.
You mean TARP like this?
No, Common Cody, not like that. The Troubled Asset Relief Program. In this program, the government's goal was to buy the troubled assets. It's downturn from being much worse than it could have been.
Downturn for Well, I hear there are market share losses over the years because the auto industry bailout. Like, what's the deal with that?
Yeah, that's true, Common Cody. In 1998, General Motors, Chrysler, Ford, they all had 70% of the whole entire U.S. automobile market. But in 2008, altogether, they only had 47%. 10.5 million cars were sold that year, which was the worst in 25 years.
Well, weren't there like problems with gas prices too?
You got that right. Yes, there were record high gas prices, which led to a decline in SUV and pickup sales. The three companies were not making any money, but they still had the industry plants and equipment costs. So no money was being made. In November of 2008, General Motors, Chrysler, and Ford told Bush they were in danger of failing. They asked the government for $50 billion, but Congress refused. In December of 2008, they requested $35 billion each, but Congress still refused. The companies estimated they would need to lay off 3 million people.
Well, actually, Rob, did the U.S. government really help these poor, troubled companies?
You know, I'm glad you asked, Common Cody. Common Cody, the U.S. government bailed them out. Basically, they threw a bunch of money at them to prevent them from going belly up. Obama and the Bush administration loaned the auto industry $80 billion so that it didn't collapse.
But did that really help the economy at all?
It definitely did. Check out this commercial from the 2008 Super Bowl with Clint Eastwood describing the rise of the American people in the auto industry after the 2008 collapse.
It's halftime. Both teams are in their locker room discussing what they can do to win this game in the second half. It's halftime in America, too. People are out of work and they're hurting, and they're all wondering what they're gonna do to make a comeback. And we're all scared because this isn't a game. We find a way through tough times, and if we can't find a way, then we'll make one. All that matters now is what's ahead. How do we come from behind? How do we come together? And how do we win? Detroit's showing us it can be done. And what's true about them is true about all of us. This country can't be knocked out with one punch. We get right back up again, and when we do, the world's gonna hear the roar of our engines. Yeah, it's halftime America, and our second half's about to begin.
Oh, well, how did people feel about that?
Good question. Critics at the time argued that companies should be allowed to fail because the aftermath of the industry would be stronger.
Well, that sounds like a pretty dumb plan to me.
Yeah, however, that didn't happen. In January of 2009, the government used $23.4 billion of TARP funds to create the Automotive Industry Finance Program.
Well, how did the bailout come to an end?
In December of 2013, the government announced that the U.S. Shares of General Motors had been sold, leaving the taxpayers to pay back the rest of the debt. In total, the bailout saved $1.5 million and reserved $105.3 billion in personal and social industrial tax collections. The loss from the bailout totaled $13.7 billion, with $11.8 billion related to the investments in GM.
Ding! Oh, it's time for the mystery document. Here it is. You have one chance to guess it right. You won't. And then you get shocked by the mystery pen.
Okay. I got this. So, good evening. This is an extraordinary period for America's economy. Over the past few weeks, many Americans have felt anxiety towards their finances and their future. I understand their worries and their frustrations. We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed. As uncertainty has grown, many banks have restricted lending, credit markets have frozen, and families and businesses have found it harder to borrow money. We're in the midst of a serious financial crisis, and the federal government is responding with decisive action. We boosted confidence in money market mutual funds and acted to prevent major investors from intentionally driving down stocks for their own personal gain. Most importantly, my administration is working with Congress to address the root cause behind much of the intensity in our markets. Financial assets related to home mortgages have lost value during the housing decline, and the banks holding these assets have restricted credit. As a result, our entire economy is in danger. Well, to be honest, I didn't really understand any of that, and the only guy I know from this time period is George Bush, so George Bush.
No, it was George Bush!
So anyways, just to top it all off, there was a bank failure at the same time. It started when the Blackstone Group admitted they had lost 90% of the profit during this fourth quarter. So of course, a panic on Wall Street occurred.
What happened on Wall Street?
A panic. Anyways, the U.S. Federal Reserve pumped $236 billion into the American banking system. All hope for the banks was gone, with the announcements for banking groups saying that they couldn't repay their debt.
Well, it's pretty scary.
Just a few days later, Bear Stearns received an emergency bailout from J.P. Morgan, Chase, and the Fed. One of Wall Street's biggest names had collapsed.
Weren't the Lehman Brothers involved in the banking crisis as well?
Yeah. A couple days later, the Bear Stearns incident, Lehman Brothers in London announced that they were bankrupt. Across the ocean, it was worried that the largest U.S. insurance company, AIG, would collapse and bring their entire world banking system down with it.
Cheers for following you, right?
That's correct. Eventually, after several threatened bank collapses, the G7 statement was written. It said that finance ministers pledged to unleash all the policy weapons at their disposal against the crisis. They promised to pop up bankers with taxpayers' money when necessary and use public funds to thaw out the frozen credit markets and unblock the flow of much-needed cashes to families and firms.
Did that actually work? Like, what kind of state are we in now?
Overall, the Great Recession ended in July of 2009. It was the biggest financial crisis since the Great Depression in the 1930s.
Oh, well, thanks, Obama.
Well, technically, Obama can't be blamed for the Great Recession, because he wasn't inaugurated until late 2009.
Holy bleep. Action, Rob. Oh, wait, that's wrong. We're not doing
Holy
that.
fuck, Action Rob.
That's a big bubble!
That's a big bubble.